Hello and welcome back to our channel, the best place for a happy, healthy and wealthy living. We all spend the initial 20 to 25 years of our life studying hard and trying to secure our dream job or career. We then spend the next 35 to 40 years of our life working the 9 to 5, trying to financially provide for ourselves and our families. After so much of hard work, I believe you and I deserve enough money to live the life we have always dreamt of. Maybe it's driving our dream car, living in our dream house, or maybe even giving it to charity and trying to make a difference for others. But the key to achieving that is making the right investments of the money which we have earned and saved. And if you have been following our videos on personal finance on this channel and actually implemented some of the ideas we have been discussing, you will have hopefully developed the habit to regularly manage your income and expenses to save some money every month. So I hope you are as excited as I am, because in today's video we are going to discuss how to invest that money to grow our wealth and hopefully achieve all our dreams and financial goals. But investment can be overwhelming sometimes and maybe even scary, because we have to put our hard-earned money at risk. But lucky for you, you don't have to worry now, because that is what this channel is here for. So in today's video, we are going to discuss a simple framework to understand investment and these various investment options. Secondly, we are going to discuss 3 important factors which we need to consider while evaluating an investment option. Thirdly, we are going to discuss 8 different investment options which we can consider to deploy or invest our hard-earned money. Last but not the least, we are going to discuss 3 important tips on how we can go about investing so that we don't end up losing our hard-earned money. So let's begin. When we make an investment, we are basically exchanging our money today for a future potential income or profit, or maybe even both. So there are 3 broad categories or 3 types of entities to whom we can give our money. The first category are the various institutions like the banks or maybe even the government. For example, when we give money to the banks, the bank uses that money to lend it to various businesses or companies. Similarly, the government uses our money to run the country and guarantee us a fixed return. The second category is buying real assets like real estate, gold, silver, etc. Here we use our money to buy these assets, which can give us regular income on a monthly or annual basis, and also some profit as and when we are able to sell those assets. The most important and the third category of entities are businesses or companies. So when a company is initially founded, there are very limited sources of capital. The usual capital which is available is the own contribution of the promoters, and this capital is what is known as seed capital. Once the company has established a track record and also started generating some regular income, they can also start raising capital from what are known as angel investors or venture capitalists. And as the company grows further and establish a track record of successfully running their business for a few years, they can also start borrowing from the banks. And as the company grows further and grows bigger, they can also start additional funding from what are known as private equity funds, who can actually provide the growth capital for the companies or even buy out the earlier angel investors or the venture capitalist funds. As the company matures and also is able to fulfill the criteria laid down by regulators like Securities and Exchange Board of India, they can get their shares listed on the stock exchange and raise capital from retail investors like you and me through what is known as an initial public offer or an IPO. At the second level, when we invest or give our money to these 3 categories of entities, we can do it either by lending money to them, or we can do it in exchange for our ownership. At the third level, we can lend money to these entities or acquire ownership in them directly on our own, or we could do it to a third-party agent, which are typically the fund managers or the asset management companies. We shall use this simple framework to understand and evaluate the various different investment options. There are various factors, but in this video, we are going to discuss 3 most critical factors which we need to consider while evaluating an investment option. The first factor is potential return. When we make an investment, we exchange our money today for a future potential income or profit. So the first factor which we need to consider is the potential return which we can earn from that particular investment option. Ideally, we would like to maximize our potential return as much as possible, but unfortunately, it always comes with a cost, which is the second factor which we need to consider, that is risk. Risk is the chance or the probability that we might lose our money in case something goes wrong. For example, when we are giving money to established institutions like the banks or the government, the risk would be low. When we are giving money to a mature established company, it will be less risky than giving our money to a new startup company. At the second level, investment in the form of lending money would be less risky than acquiring an ownership. This is because there is something called as seniority of capital. For example, if a company runs into an issue or goes bankrupt, the assets of the company would be sold, and in that scenario, the lenders are given preference, which means whatever money is received from the sale would first be distributed to the lenders, and if there is any money left, only then would the shareholders or the owners get any money. And at the third level, investing through a third-party agent would be less risky than investing directly, because the fund manager will have the required expertise to better manage our money. And it's basic finance that risk and return go hand in hand. So an investment with a huge potential return will typically have high risk, whereas an investment with low potential return will also have low risk. The third factor which we need to consider is liquidity. Liquidity is the ease or how quickly we can exit an investment. So depending on when and how quickly we might need our money back, we need to evaluate the liquidity of an investment before putting in our money. Let us now discuss the 8 different investment options. The first investment option is putting our money in a savings account. In this option, we are basically giving our money to the bank by lending money on our own. And since we are lending money to an established institution, the risk is very, very low. But naturally, the potential return also is very, very low. The interest on a savings account deposit ranges from just 2 to 3% per annum. The liquidity of this investment is high because you can withdraw your money anytime. One important thing we need to note is that our net return is actually negative. This is because of inflation. If you look at the last 10 years, the average annual inflation in India is about 6 to 7%, which means the cost of goods has gone up by 6-7% per annum. So our return is actually negative for 5%. So we should limit the amount of money we put in our savings account to just our 1 month regular expenses. The second investment option is a fixed deposit or a recurring deposit. In this investment option, again, we are giving money to the bank, but this time for a non-fixed period. And we again do this in the form of lending on our own. Here again, since we are giving money to established institutions and we are doing this in the form of lending, this investment has a very low risk. The return is higher than the savings account and ranges between 6 to 7% depending on the bank and the investment duration. The liquidity is medium because your money is locked up for the duration of the fixed deposit. You can of course take out your money before the end of the period, but the bank will charge you penalty. The third investment option is government bonds or securities. The government every year spend more than the revenue which they earn, so we always have what is known as the fiscal deficit. So the government bridges the deficit by issuing various securities or bonds. So when we buy these bonds or securities, we are basically giving money to the government and they guarantee us a return using their sovereign taxation power. We typically do this by lending money to the government directly on our own or through a third-party agent. Here again, since we are giving our money to the government and we are doing this in the form of lending, the risk associated with this investment is very low. The potential return depends on the type of security, but for a 10-year government bond, the typical yield ranges from 6 to 7% per annum. And since these government securities and bonds are regularly traded, the liquidity for these instruments are also high. The fourth investment option is real estate. Investment in a real estate property exposes us to the overall economic environment, the local real estate market conditions, as well as various other legal issues. And we are doing this by acquiring ownership directly. Therefore, the risk associated is very, very high. But if you invest in the right property at the right time and at the right location, the potential return is very, very high. But one big challenge with a real estate investment is low liquidity. When you decide to sell, it could take you 6 to 12 months to find the right buyer and also complete the legal formalities which are required. The fifth option is investing in our own business. In this option, we are putting our own money in our business in exchange for an ownership directly. Since in this option, we are investing in a business or a company with no track record and actually acquiring ownership directly, the risk associated is very, very high. But at the same time, the potential return is very, very high because there's no limit to the amount of return which we can earn if that business does well in the future. The liquidity for this investment is very, very low because until the business becomes successful and you're able to find a potential buyer who would buy a part of your company or your whole company, it would be very difficult to find an exit for your investment. The next and the sixth investment option is investment as an angel investor or in a venture capitalist fund or a private equity fund. This investment option is meant for high net worth individuals because the minimum amount of money which we need to invest is quite huge. These funds are regulated and are registered with Securities and Exchange Board of India as alternate investment funds or AIFs. So what an AIF does is it pools capital from various high net worth individuals and they use this capital to acquire ownership in various startup or private companies. As of date, the minimum minimum investment is INR 1 crore. So when we invest in an AIF, we are basically acquiring ownership in these various startup companies through the third party agent, which is the venture capitalist fund or the private equity fund. Since we are giving money to various startup companies and we are doing this so by acquiring ownership in them, the investment is still very, very risky, although we are doing it to a third party agent. But the potential return is very, very huge because the kind of income or profit which you can earn if the startup company does well in the future is very, very huge. The liquidity for this investment also is very, very low because you can't take back your money until the end of the term of the alternate investment fund. The seventh investment option is investing in mutual funds. When we invest in a mutual fund, we are basically giving our money to various listed companies, and we can either do this by lending money to them if we are investing in a debt mutual fund, or we can do this by acquiring ownership if we are investing in an equity mutual fund, and we are either lending or acquiring ownership through a third party agent, which is the mutual fund. So the risk can range from medium to high. The risk would be medium if we invest in debt mutual funds, and it would be high if we invest in an equity mutual fund. The liquidity is medium because it takes about 2 to 3 working days to exit or liquidate. The last and one of the most important investment option is the stock market. So when we invest in the stock market, we are basically giving our money to these listed companies by acquiring an ownership in that company directly on our own. Since we are buying ownership directly, the risk also is very high because our investment is exposed to the overall performance of the company in which we have invested. The potential return also is very high because if the company does well and grows and the share prices go up, and we can make huge profit as and when we exit and sell those shares. The liquidity also is medium because it takes about 2-3 days to exit an investment and get back your money. Let us now discuss 3 important tips which we need to consider while planning our investments. The first and the most important tip is start early. This is because of simple common sense or a science or math known as compound interest. Albert Einstein rightly said compound interest is the 8th wonder of the world. Let's illustrate this with an example. Let's see what happens if we invest 10,000 per month at an annual average return of about 10% starting from the age of 25, 30 and so on, and see what that amount accumulates to by the time we have to retire at 60 years. As you can see from the graph, if we start investing this amount at the age of 55, the investment accumulates to just about 8 lakhs. But if we start this investment at the age of 40, the investment accumulates to about 76 lakhs. But if we were to start this investment at the age of 25 years, the investment accumulates to 3.8 crores. This doesn't take into account inflation, but the amount is still huge considering that 10,000 per month is something any of us can achieve to invest. You can even see the difference magnified if you actually change the potential return to say 12%. The amount goes up to 6.43 crores. So the first and most important tip is to start early so that we can take advantage of this compound interest effect. The second tip is to plan our investments based on our financial goals. To start with, we should put enough money to cover our 1 month regular expenses in a savings account. Secondly, we should try and set aside an emergency fund which should cover about 3 to 4 months of our regular expenses. And we should put this money either in a fixed deposit or a very liquid mutual fund. The remaining money which we want to invest for a longer term or for our retirement, we should invest in the various other investment options. The third and the last important tip is discipline. As we need the discipline to generate savings on a regular basis, we also need the same discipline to invest and grow our wealth. As we just discussed, just by starting early and consistently investing a decent amount, we can generate huge amount of wealth. So we should not get distracted by these flashy or get rich quick schemes which promises extraordinary returns, because more often than not, these schemes end up being illegal or being a fraud, and we could end up losing lots of money and derail our long-term investment plans. Hope you find this video helpful. If you do, please do not forget to give a thumbs up and leave your comment or feedback below. If you haven't subscribed to our channel, please consider doing so for regular updates on personal finance. Thank you so much for watching. Have a good day.